U.S. broker and agency merger and acquisition deal volume fell in 2023, down from 45% from the 2021 peak and down 20% from 2022. What catalysts are behind the drop, and what shifts on the horizon could result in a return to robust M&A activity? I'm Meg Green with Insurance Insider, and welcome to our webinar, The Calm Before the Storm, Bracing for the Next M&A Wave, offered in partnership with S&P Global. I'll introduce our panel in a moment, but before I do, I'd like to invite the audience to share their questions and comments. We'd like to make our next hour together as interactive as possible. So now to introduce our panel, joining us first is Chris Winter, Insurance Leader of S&P Global. Hi, Chris.
Good morning. Thanks for having me.
Yeah, my pleasure. Next up is Keith Rue. He is Insurance Investor with Bain Capital. Hi, Keith.
Morning, Meg. Thanks for having me.
Yeah, my pleasure. And up next is John Stamatis. He is co-head of North America for Howden Capital Markets and Advisory. Good morning.
Morning.
John.
Glad to be here.
Glad to have you. And finally, we have Phil Trem, who's President of Financial Advisory for Marshberry. Hi, Phil.
Morning, Meg. Thanks for having me.
Yeah, my pleasure. So thanks, everyone, for joining us today. Chris, I was hoping you could kick us off with an overview of the state of the M&A market in recent years.
Yeah, absolutely. And thanks again for having me. It's always fun to talk M&A, whether it's, a lot of big deals going on or a lot of activity, or because it's a little cooler and drier like we're seeing now. And I guess before I even get any deeper, I should probably need to offer up some disclaimers that I work for the Market Intelligence division of S&P Global. We're the data providers. A lot of you may be familiar with like our tools such as CapIQ, CapIQ Pro, formerly SNL. So S&P ratings and indices are separate divisions. And I think it goes without saying that my comments are my opinions, not necessarily those of S&P Global. And so as far as like what have we been seeing in the market, you alluded to in your intro comments, Meg, about, volume's been down a little bit. We put out some articles recently that summarized underwriter and broker M&A since 2020. So it's, 4.5 years. And there's definitely a clear downward trend in the number of deals. For carriers, for underwriters, we were seeing 25 to 35 deals per quarter. But in the last 12 months, that's dropped almost in half to like the 15 to 23 range. And for brokers, the trend is the same. The number of deals is a lot higher. It's typically trending downward. Brokers were having 150 plus deals a quarter, and with several quarters in 21 and 22 that saw 220, even 300 transactions. And it's worth noting that for brokers, the 2 quarters this year are the fewest number of broker deals within the last 18. I guess a little bit of good news for underwriters. The second quarter of this year is already off to a better start than the first quarter. The numbers in the second half of this year, or the second quarter of this year, are comparable to most of 2023, and the value of those transactions is higher than what we saw through most of 22. So I think volume's down, but I think it is kind of trending a little bit in the right direction. A lot of the Q2 value that we saw was, particularly for brokers, was Nippon spent $3.8 billion for 20% of corporate. That's on the life insurance side, so probably not super applicable to this audience because it's mainly annuity and other retirement products. And then the second biggest deal of this quarter, I think was kind of interesting. It was Ambac, which writes a wide mix of things like auto and workers' comp, financial and mortgage guarantee, and it writes it relatively evenly across the country. It doesn't have the regional focus that some smaller carriers do. And they agreed to sell their financial guarantee business for 420 million to Oak Tree Capital Management. At the same time, they also bought a 280 million stake in a company called Beat that's based out of London. That's kind of an underwriting and MGA product. I think we're going to cover MGAs a lot more later on. But oddly enough, shares fell nearly 20% when that deal was announced earlier this month, and has kind of stayed at similar levels. And that's on the heels of the stock of that company actually popping 20% when their first quarter earnings came out in May. So if you look at their stock chart, it's kind of funny. It pops up with their Q1 earnings, and then hovers for a couple weeks, and then drops back down with that when that transaction was announced. Also worth pointing out too is some of the broker transactions. They had a couple outlier deals in the end of last year and to start this year. If you look at broker transaction value, not the number of deals, but the dollar amounts of those deals, it was, kind of consistent. I'm looking at my graph over here between, a billion and a half for most of the last 4.5 years. And then in the fourth quarter of last year and the first quarter of this year, we both saw deals 10 times that amount, like individual deals. Most of those are on the life side. And one of those was in the first quarter. Truist sold their life insurance arm for 12.5 billion. And that was nearly all of the broker transaction value we saw in the first quarter. And the buyers in that case from Truist were several private equity shops. And I think that private equity influence is going to come up several times later today. Um, and then the outlier deal for Q4 of last year that I mentioned was Aon spent over 13 billion to acquire NFP, which is another kind of wealth management advisory group, kind of again more on the life side. Um, so most of that activity is on the life side. It's also worth noting that everything I just brought up was about the insurance industry, but M&A for the first quarter in the U.S. as a whole, like kind of across industries, was down a little bit. S&P put out an article, I guess it was in April, that talked about that a little bit, saying that volume was down. Um, so volume may be down a little bit, but it's not dead. I think deals are still happening. At billions of dollars of stuff we're seeing. So I think that
We're losing your audio a little bit, Chris. Is it possible to adjust your microphone up?
Yeah, well, that was the last thing I had to say about kind of the state of the industry anyway, so I guess it's good timing.
Well, we missed the very last thing we missed. If you could repeat that.
Yeah, I was just saying that a lot of that industry was on the life, a lot of that activity has been on the life insurance side. And everything, all the comments I made so far were generally about the insurance industry. But across all industries in the US, M&A activity was down in the first quarter. S&P put out a piece, it must have been in April, that talked about how all transactions were down a little bit in the first quarter.
So, what is driving that drop in M&A activity?
I think there's a few things contributing to that. Um, I don't think it's any surprise that we're not seeing a lot of blockbuster deals like Ace Chubb or AXA XL. Certainly, there's two deals on the life side that I mentioned before, with Aon buying NFP and Truist selling their insurance business. Those are massive deals, but they're not in the same class as two carriers, two underwriters getting together the way like Ace Chubb or AXA XL did, or some of the big health insurance deals that we've seen in the past too. And I think the reason for that is it's pretty obvious. It's that the Biden administration and the FTC has kind of made antitrust stuff a focus, and I think companies are a little hesitant. They don't want to spend a lot of money trying to make a huge deal happen um, that ultimately won't pass, regulatory scrutiny. So I think that's one of the factors kind of influencing blockbuster deals. And then something influencing smaller deals is just interest rates. I think this comes up in probably every webinar that's being hosted these days. Is interest rates and some other factors have materially changed the valuations of some companies, and I think it's difficult for sellers to come to grips that their business may now be worth less than it was a few years ago. For example, if you thought you could sell your company for 100 million in 2 years ago, it may be tough to stomach accepting an offer of 85 or 90 million. And I think that's just the reality that we're in right now. And so that's the interest rate influence from the target company point of view, but it can also impact the buyer's budget, right? If they have to pay more to issue debt, um, they probably can afford a little bit less. Another reason I think that's driving a drop in M&A, particularly on the P&C business, is that it's in some ways it can be more attractive to a more attractive use of capital to just do it organically rather than um, through an acquisition. And I think that may be even more true during today's high interest rates environment. And I think the last comment before I hand it off to my fellow panelists, because I can tell they're itching. And this last comment, it's probably not going to make me any friends with this group, but and it's also a good time to remind people that I'm presenting my own opinions, not necessarily those of S&P, but that acquiring a company and integrating it is hard. And it can be painful, and it doesn't always work out the way that it's drawn up on paper. Um, at our insurance conference last fall, one of the panelists, I believe from RBC, was more blunt than anyone I've ever heard. He said that a lot of executives currently don't want the headache, that was the term he used, of an acquisition. I think those executives have a lot of headaches that they've been dealing with, whether it's COVID, remote work, interest rates, partisan politics. I mean, that list of headaches is quite long. And so there may be somewhat less of an appetite to acquire and integrate a company these days.
And
Thanks,
I
Chris.
can, May I can provide some thoughts from like the investor perspective, and then I'd love to hear Phil and John's perspective as well. I think the best assets and best deals are still getting done. I think there's just a high degree of selectivity, right? Because academically speaking, higher interest rates drive higher cost of capital, which ultimately should drive down valuations. I just don't think we've seen that, right? I think valuations have maintained, or in some instances, we'll get to MGAs in a minute, but have actually increased, right? So I think what that really means is you're going to be more selective about the deals that you do because you need to hit that clearing price, right? And then for, I'll call it the tier B, tier C assets, there's just a bid-ask spread that is probably pretty wide right now. So maybe all that is a long-winded way of saying I think the best deals are getting done. That's reflected in the data. I think it's the lower quality deals, that investors and even to some extent strategics are, just kind of stepping away from.
Yeah, it's interesting. I maybe provide a little bit of a counterpoint to Chris and Keith, at least from our lens. So, Marshberry focuses a lot in the predominantly distribution space, so retail, MGA, wholesale. And while Meg, your percentages were really spot on relative in your intro relative to what we've seen since 2021 and is a downward trend, 2023 was still the third highest year on record in the distribution space and total transactions. So context is really important in what we're comparing it to. 2021 was quite an anomaly when President Biden announced his desire to eliminate capital gains in March of 21. And, any insurance broker or agency who had any idea of potentially selling in the next 5 years ran to the finish line to do a transaction. And there was an incredible spike. It was about a 34% increase from 2020 to 2021. And yes, that was a COVID year, but it was still a very active year. So we're talking about where we were from a peak. So the last 3 calendar years, 21, 22, and 23, are the 3 highest years in record of total transactions. Interesting. And again, Chris, I think your comments about what we're seeing quarter over quarter, month over month, we tend to see, because of the volume of firms that are acquiring in that space, delayed announcements. So typically when you're looking at where are we year to date through May, the numbers are typically down when you're comparing to year to date May in prior years, because firms retroactively announce transactions and it spikes the numbers up. So when you're looking at a point in time, it feels like we're in a lull. But in the broker space, we're not. I actually believe we're going to end up probably exceeding 23 volumes, potentially exceeding 22 volumes in total deals in the space this year, based on a couple of things. One, there is continued fear or reignited fear of potential significant tax changes that could happen if President Biden is reelected. But also in late 22 and early 23, we did see a crunch in the credit markets where the amount or allowable amount of debt that a strategic private equity backed broker could borrow was significantly constricted. So you started to see the strategic buyers pull back a little bit, but in, let's call it late 23, early 24, those restrictions or the constriction we saw in the market starting to loosen up again. So the credit markets, while more expensive, as Chris and Keith alluded to, the capacity is available again. We're seeing firms restructure their debt. There's light at the end of the tunnel, kind of, because there is still an expectation the Fed is going to lower rates, which will create a little bit of additional cash flow. So we're starting to see increased demand in the space, and we're starting to see a pickup in supply as sellers or brokers are trying to determine what their future looks like. So while we are down relative to the past 2 years, the activity is still very strong. And if you look 5 or 10 years out, we're still going to have one of the highest years the industry's ever seen in total M&A activity.
Yeah, and if I could just add a few points, and I think we'd be remiss on not acknowledging the fact that this is a hard market almost across the board in both reinsurance and insurance that we're in. And I believe, and we believe at the Howden Group, that that's influencing a number of the factors that Phil and Keith and Chris have hit on, right? So when you think about distributors and MGAs, which tend to have more private capital and more financially oriented investors and more of a growth orientation, you're seeing the hard market really add fuel to the fire from a top and bottom line growth standpoint. And so that's widening bid offers on a lot of the deals, particularly, as Keith noted, for some of the more marginal assets where sellers want to get paid for a continuation of that growth and a continuation of that growth and profitability, and buyers maybe want to take a more measured view or maybe assume some regression to the mean. And then similarly in sort of the carrier world, from a buyer standpoint, we're seeing a lot of commentary around just opportunity cost of capital, right? And the fact that executives don't want to deal with, I'll use a softer word than headache, but the distraction of an M&A integration and the use of capital for M&A when organic opportunities in a lot of these carriers' core portfolios are so attractive. And so there's just a high activation energy for a lot of those buyers to get involved in the market. But also, I think we're seeing a lot of carriers take this as an opportunity to sort of streamline operations and dispose of non-core assets to be able to put proceeds and that released capital to work, again, in core businesses where market conditions are really attractive and really make hay while the sun is shining. So the sort of overall hard market drivers like reinsurance, capital supply and demand, and interest rates and inflation are things we're watching really closely, because those we believe are really what's underlying a lot of the themes that Keith and Chris and Phil have correctly pointed out so far.
Yeah, John, I think the growth point's an important one, because we've talked a lot about brokers, but if we kind of like step back for a minute and think about the MGA market, I think it really is the growth dynamics that exist in that market that's driving what has been and will continue to be significant interest around MGAs. So you think about the MGA market in aggregate in terms of non-affiliated MGAs, is far outpacing the broader P&C industry in terms of gross written premium. It's something like a 20% compound annual growth rate over the last 5 years. And some of that, to John's point, is cyclical in nature, right? The hard markets absolutely benefited the MGA landscape, but a good portion of it, I would argue, is secular in nature, right? So the structural shift of premium out of the traditional markets into the E&S and specialty markets is a huge tailwind for MGAs, and this kind of phenomenon of underwriting talent leaving traditional carriers to enter kind of more entrepreneurial, environments and structures, which, is the MGA platform. So I don't think any of what I just said is all that novel. I think those trends are relatively well understood. But I think what is interesting is if you look at, the share gain that the MGAs are taking within the broader P&C market. So I think it's gone from something like 6% in 2015 to, somewhere north of 10% now. And that absolute number is impressive, but I think what's even more interesting is the acceleration of that share gain year over year. So I think MGAs now are capturing something like 1% of the P&C market on an annual basis. And so when you couple all of those growth dynamics with what is an increasingly competitive buyer universe. So you've got the MGA consolidators, largely PE backed. You've got the wholesalers that all have large program divisions at this point. And more recently, you've got the entry of retail brokers. It all kind of culminates in a very competitive dynamic when you think about acquiring MGA assets, and that hasn't precluded deals getting done in the MGA consolidator world. So all of those deals are clearing at mid to high teens multiples. I think where you have seen a little bit of compression from a deal activity perspective is for the monoline MGAs. And I use that term broadly. So that's anything that's not a diversified platform. That bid-ask spread that I was mentioning earlier, I think that acutely exists in the MGA world. So that's something that I think we're watching, and there's a few large assets in the market now that we'll see which way those trade. But it's kind of top of mind for us, and I think a lot of folks that look at the MGA world.
Yeah, Keith, it is interesting. You talked a little bit about the kind of valuation thesis and really the expectation with rising interest rates and how we would expect valuations to come down, particularly with private equity involved and driving a lot of the consolidation we're seeing in the brokerage or distribution space. So whether it's retail, MGA, wholesale, we haven't seen it yet. And I'm not sure if we're going to. And I think there's a couple of reasons why. Certainly the cost of capital is higher, but if you were to go back and look at the last 10 years worth of recapitalizations that are happening in the strategic space from one private equity firm to the next, most of those holding periods are significantly faster than what would be deemed a standard kind of 5-year or 5 to 7 year exit period. And so what's happened over the last decade, and it's not universal for all, but I think generally the returns that private equity firms have been getting have been greater and faster than kind of the stated thesis. And as a result, the hold period, you theoretically there's room to pay a little bit more, maybe have a little less arbitrage and hold the asset a little longer and still get the desired return. At least that's what we're speculating. And so valuations, again, in the distribution arena haven't come down. Actually, for kind of high quality assets who are growing above market averages, they're actually seeing valuations increase, counter to what you might think. And a lot of it's being driven by just pure supply and demand. There's incredible demand, and supply just isn't keeping pace. So if you see a good asset, there's a lot of competition around it. And it's a really good time to be the owner of one of those organizations if you've really built a strong foundation for which someone can invest and grow, whether that's a new financial sponsor coming in to create the next platform, or a strategic who's looking for the strategic advantage, the industry specialization, the monoline MGA, whatever it is, the underwriting capabilities, whatever the talent is driving. But there continues to be incredible demand, and in the just broad retail brokerage space, we're seeing new startup firms pop up almost every quarter, where you think there's going to need to be a consolidation of private equity or private capital backed brokers. We're seeing new ones start out of thin air, when you didn't quite think there was enough bandwidth for anyone new.
It's a great points. We've opened the door a little bit. I'd like to explore the different sectors a bit more, and we've done a great job starting to talk about this. But one area we hear a lot about, or I guess we used to hear more about, is insurtech. And Chris, I was hoping to get you in the conversation. What is going on with insurtech M&A?
Yeah, frankly, I was kind of expecting insurtechs to be more of a target in the past year. So, I figured that the interest rates would hurt a younger, less mature company, and that an older, established carrier would scoop up a distressed insurtech at a bargain. I think that was something that a lot of us here were expecting. Travelers bought Corvus at the end of or at some point last year for $435 million, and I was kind of expecting that type of deal to become a lot more common. Corvus seems like the quintessential insurtech. If you think about it, one of their taglines is loaded with every buzzword you could throw in there. I think it's powered by proprietary AI-driven cyber risk platform, right? Like, it doesn't get more insurtech than that. I think we were all kind of expecting more of those deals to happen. And I guess one of the reasons that we haven't seen that is insurtechs just haven't disrupted the market in the way that maybe they were self-predicting would happen. Um, some of that could be because of pandemic related timing. If you look at the glass half full, but I think many outsiders just misjudge the massive barriers to entry in our industry. I doubt this audience needs a reminder, but being regulated by each individual state's a huge challenge. It's tough getting licensed. It's tough moving to new geographies to write new lines or to write new lines of business. And I think that has caused a lot of those insurtechs to grow at a pace that is more in line with an insurance company and less at the pace of a tech company. Um, and I think all that's kind of made them a less appealing target. Another challenge that I think has faced them is that some of the technology just simply hasn't caught on as much as it should have. If we take telematics, for example, 3 years ago, USAA bought Nobler, and that was a telematics firm for $100 million. And I think telematics makes so much sense. Let's assess driver risk and charge people based on how they actually drive, right? Do they speed? Do they swerve? Do they brake hard? Do they drive and park in accident prone areas? Like that makes a lot more sense than assessing risk and charging based on, credit score or age. And I think um, a lot of the data even shows that if you use telematics, your premiums will go down. And despite all that, it hasn't taken a hold. It hasn't become as popular as it kind of a lot of people were predicting. I think there's this perceived invasiveness with telematics that people don't want Big Brother in their car, and because of that, it hasn't taken over the auto insurance industry like a lot of us have thought. Um, and I bring that up because I think that if telematics had gotten a foothold like people were predicting, then you would have seen a lot more activity, and every auto writer, commercial and personal, would have been scooping up telematics firms, right? The USA Nobler is the one deal that comes to mind, but that was in June of 21, right? That was 3 full years ago, and I don't think there's been a ton since then. So that's the insurtech side. I'm looking forward to hearing what other people have to say about MGAs. I think that's it's fun hearing you guys talk about that because as a data provider, there's not a lot of good data on MGAs that's publicly available, and so I don't always like gravitate to that area a lot. But I know that that market is hot and it's been very fragmented for a long time, which means it's ripe for consolidation.
Yeah.
Yeah,
Yeah.
Keith, do you want to jump in?
Yeah, so I kind of already walked through what I thought was driving a lot of like the interest in the MGA market. The other thing, I think Chris, your point's a good one, right? I think something like 70% of insurance deal volume is captured by retail brokerage. So I think in the numbers that we're talking about here at a high level, it masks some of the underlying trends, and that's certainly probably true in the MGA space, where I think there is just heightened deal activity there. There's less large deals, right? There's just huge scarcity value with regards to big platforms in the MGA space. But I mean, my expectation is we'll continue to see an uptick in deal activity as it relates to the MGA world. And the natural derivative of that is the renewed interest in the hybrid or fronting carrier model. I mean, that business model is a direct beneficiary of all the growth that's happening within the MGA and program space more broadly. There's just not enough capacity that exists in the traditional program market. So more and more MGA premium will move into the reinsurance market. And those fronting carriers are evolving now from what used to be purely conduits that sat as an intermediary between the MGA and the reinsurance market to now they're acting and are being required by their reinsurance capacity providers to act as true insurance carriers, meaning not only are they required to source the risk, but they need to evaluate, structure, and underwrite it like a traditional carrier would. So I think that evolution is still in probably inning 1 or inning 2, even though the fronting model's been around for quite some time at this point. So I think that's something, obviously where we and others are kind of closely watching is the interplay between the two.
Yeah, Keith, the only thing I'd add to that and the point you made earlier is just the ability of the MGAs today to capture, analyze data at very high fidelity and very efficiently, and make track records more portable and make it easier for both issuing carriers and reinsurers to sort of validate what they're being told has driven a lot of the the secular aspect of the business that I think is moving into the MGA market as well.
Yeah.
Thanks, John. And I wonder, could we expand the conversation back to agents and brokers, which we have talked a bit about that. But Phil, maybe we can come back to you. Do you see that area as ripe for growth, and what catalyst could might maybe reignite the market?
Yeah, the retail brokerage space, particularly, continues to be, very segmented. There's still, depending on which publication you're talking to, 25 to 30,000 retail brokers in the U.S., which is massive. And when we're showing acquisitions of 700, 800, 1,000 firms a year, we still don't see the drop. Predominantly in supply, because most of those counts don't include captive agents that are captive to a certain carrier. And so when Nationwide, as an example, gives all of their captive agents independence, you drop another 3, 4, 5,000 independent firms into the universe, and those are accounting for a number of the transactions that are happening. But we're in an interesting time now. There are transactions that are done, and you see regeneration. So for every 10 deals, you see 1 or 2 form, maybe 3 to 4 years later when the restrictive covenants from that transaction die out. But we talked a little bit about, John did a great job of highlighting the hard market and what we're seeing. So it's interesting right now, for the last 2.5, 3 years, most independent retail brokers are seeing better organic growth than they've ever seen in their lives. And so their top lines are growing, their profits are growing in just pure dollars. And some firms are sitting back and smiling and congratulating themselves on all their success, which is great. They should be happy that their business is growing. But when the tide goes out, we're in probably the largest or the longest sustained hard market the industry's ever seen. And at some point, this cycle will end and the tide will go out, and firms that haven't invested in a true sales organization or growth are going to struggle. So, relative to kind of reigniting the M&A space, again, my perspective is that we're not really in a lagging period. We still have had really strong activity, and that activity is climbing a bit. Some of it's going to be government and tax fear related, and some of it is, really driven by COVID. When the pandemic hit in 2020, the end acquirer, the purchaser of insurance, the insurance broker's clients, started to look around and realize how segmented their relationships were across all of these different spaces. And whether it's employee benefits, their property and casualty insurance, the HR support they had in different areas, the 401k support, you're starting to see firms, particularly larger brokers, think about how do they capture relationships, and they're investing outside of what used to be their core. So you're seeing retail brokers, as Keith mentioned, building wholesale divisions, building MGA divisions. You're seeing retail brokers invest in retirement plan advisors or even individual wealth advisors. We're seeing HR consulting firms and payroll companies start to get acquired, so that as they build these trusted relationships, they have more to offer and try to grow wallet share within each of these different clients. And as that happens at a much broader scale, you see this typical independent retail broker look around and wonder, am I still competitive? So we're not seeing firms today sell just because the average age of ownership is in their 70s. It's not just an exit strategy, but a competitive strategy to say, I still have a lot to give, but I have to decide whether I'm going to build these resources and capabilities myself, invest our hard-earned return, and take a risk that I can still compete, or join someone who's already built it out and leverage the tools and resources and capabilities that our clients are now expecting as a result of the pandemic and kind of a shift in the market from a buyer perspective, a buying habit perspective. So consolidation is going to continue because the market is getting more competitive. The expectation that your broker knows your industry, knows your niche, and comes from a consultative lens as opposed to just spreadsheeting, carriers and negotiating premiums. They want an advocate, not just a broker. And so you're starting to see the expectations of the end buyer shift, which is creating more competition. And, some independent firms are digging in and making those investments, and others, the average age of a lot of the firms selling is in their 40s. They're not selling to exit. They're taking some chips off the table, but view it as a competitive step in the future of their business. So I do think you're seeing a shift in the expectations of the market and remaining competitive, but we would be remiss to not keep our eye on what's happening in the election in November and what downstream impacts that could have to net value, which I think we're going to get to a little later today.
Yeah, thanks, Phil. If I could follow up, when you mentioned the average age of 70, was that hyperbole or?
Yeah, no, it was hyperbole, but I think there's a stigma that, a lot of times organizations, wait until they're ready to retire and then they want to sell. And whether it's whether it's life, whether it's retail, whether it's wholesale, in the insurance space broadly, these businesses are successful because of the entrepreneurs that built it. They're relationship based. They're not selling, widgets or a hard product. So there is a misconception that people wait until they're near retirement age and sell and want to go put their feet in the sand. And in reality, that doesn't happen in this industry. If that's what you want, your business is probably worth 30 to 40% less because the buyer's assuming a significant chunk of your revenue is going to run out the door if you're no longer there. So I think it's just kind of bucking a misconception that most firms aren't selling because they're trying to sell out or get out. They're selling because, yes, valuations are really high, but it's a competitive decision to try to figure out a way to continue to be scalable and competitive in their marketplace. So certainly there are firms that are selling as a perpetuation challenge, but I would say the vast majority of them aren't really in that camp. Although I think that's a common misconception in the industry. So no disrespect to anyone who's 70 plus and running a thriving business. It was more feeding into what I think is a misconception in the space.
Thanks for clarifying, Phil. I'd like to follow up on your comments about the impact of a change of leadership in the U.S. I'm not sure if anyone on the panel would want to explore also change in the UK and Europe. And just a quick reminder for the audience, thank you for sending your questions in. We are going to try to get to those as soon as we can. But if we could tackle the change in government leadership first. And Phil, would you want to kick us off there?
Yeah, happy to. 2021 was a prime example. I think it was March of 21. President Biden announced a potential change in taxes, which was very complicated, but ultimately the end result was that there was an attempt to eliminate capital gains, which would effectively doubled the tax rate paid by those that sell their business. In the 2024 late January, early February State of the Union address by President Biden, and a subsequent release of the 25 budget by the White House or budget plan by the White House shortly thereafter, the State of the Union address, a very similar tax plan was laid out. I don't think anyone has a real opinion or idea. Everyone has opinions. Nobody has any clue, I don't believe, of who's going to win the election in November. And whoever wins the White House, whether they'll have support of Congress behind them to actually pass laws. But there are changes coming. There was the Job and Families Act in 2017 or 18 that will expire mostly at the end of 25, which will raise taxes on every American and the individual income tax rates. So taxes are going to be a big conversation coming up over the next 6 months. And then depending on who wins, what that means in 2025, because without legislation, ordinary income tax rates will revert back to where they were prior to the Jobs and Family Act that passed during President Trump's administration. And that, is going to be a big impact. Whoever is the sitting president isn't likely going to want to see taxes go up on middle America. And as a result, there has to be something that happens. Legislation will have to happen in order to stop that. So we expect, and we're seeing even now in the US, that just the idea of such a dramatic increase or change to the tax strategy is causing firms to make decisions to explore the market. And the closer we get to November, depending on which candidate gains momentum or depending on the outcome of the elections, we do think there's going to be another significant spike in activity. So you hear it from buyers too. They're kind of gearing up. They're kind of holding on to capacity, expecting to see a rush, and they don't want to miss the opportunity to potentially partner with a high-performing firm that historically wasn't considering a transaction, but given the financial ramifications or outcomes of what could be, a significant tax change, may decide to explore the market otherwise, which is exactly what happened in 2021 and why we had such a dramatic peak and a 34% increase in overall deal activity year over year. So it's something definitely to watch, and just like I said, the momentum or fear behind a change, whether it's realistic or not, is definitely shaking up the market a bit right now.
Yeah, I mean, I think the question was about national leadership change and elections. And Phil, you did a great job um, walking through the landmine that is that question. But it's worth pointing out too that the legislation could impact things on a smaller scale. Like in Florida, DeSantis in I guess it was late 22, in December of 22, he got a few things passed that has really kind of helped that market change. Right, there was legislation that prohibited one-way attorney's fees and assignment of benefits, and that lowered litigation a lot in that state. Defense and cost containment expense, especially basically legal expense in Florida, had always been several times the national average. National average was 1.1, 1.2. Florida was 4%, 8%. Like it had really jumped up. And so that legislation that he was able to enact, I think really helped. And they were also, created a state reinsurer, and some other things. So like there's a lot of legislation at a state level that can have a big impact on the market too, particularly in states where the insurance commissioner is an elected position. Um, that could be a whole webinar in of itself and is beyond the scope of what we want to talk about today, but figured we should point that out too.
I think we can probably move on from this topic, but maybe the one last point I would make is, there are some, I would agree with Phil. I think tax is the big one. But there are some other, I'd say ancillary impacts in Republican versus Democratic administration. Antitrust is a big one, especially when you think about the large deals. And then, you've got the DOL rule, right? And that's got a direct impact on life and annuity distribution. So, all of that stuff is a bit back in the blender because, it's probably a coin flip on where we land at this point. So I think there's a lot of impacts to insurance just around the way the different administration just thinks about regulation broadly.
Yeah, Keith, I don't think we want to delve into it as well, but the FTC ruling on non-competes and whether that gets challenged, upheld, whether that gets to the Supreme Court. I mean, that decision alone is going to have a significant impact on M&A everywhere, but will have a significant impact on the insurance space, depending on the outcome. And I think as it's set, it's supposed to go that without intervention, that ruling will go into effect in early September. So expect to see some activity in that over the next 90 days as well.
Thanks, Phil. I'd like to bring in an audience question. Thanks very much for those. This question says, to me, a prime example of a limited appetite for M&A is Aspen. It's been held by Apollo well past the 5 to 7 years. It seems to have exhausted IPO, reverse merger, protecting the past for the lost portfolio transfer, etc. What is driving no interest? Is it simply a matter of price?
So I'll start there, and I'll make a more generalized comment, right? Which is going back to some of the points that were made earlier. Look, Aspen's performance over recent years has been excellent based on their public financial results. So I do think a lot of what's driving, particularly in the carrier arena, a little bit of a lack of activity is really two things. One, it is sort of the bid offer point, right? And buyers' willingness to pay for ongoing very good performance against the backdrop of really attractive market conditions in their core markets is one point, right? And then the second point, and this goes beyond just the carrier landscape, you've seen over the last 5+ years just an ability for companies and even high-performing companies to remain private for longer and sort of have more patient private equity capital behind them. You're seeing more PE to PE deals, particularly in distribution. You're seeing more creative recapitalizations to sustain that and really strike when the time is right, either in terms of a private deal to somebody who's willing to pay a strategic premium for something, or in the IPO market, which I think we've seen mixed results in recently, but should really attractive IPO market conditions return, obviously, return to more and more of these companies going public through more of a tried and true path.
Thanks, John. Keith, would you want to jump in here?
Yeah, sure. And again, I'll probably comment more generally to the just P&C carrier market than the Aspen situation specifically. But I would kind of reiterate a comment I think John made back at the beginning of our conversation here. The vast majority of activity we've seen on the balance sheet side of the property and casualty industry has been strategic, right? There has not been a lot of sponsor activity, and it's largely been about strategic repositioning, right? So you think about effectively, you had Liberty kind of divesting their LATAM business last year. More recently, you had Allianz selling its fireman's business to kind of refocus on kind of the large market side of things. So I think that we will continue to see. I think we will continue to see muted activity from the sponsor universe. And I think there's three primary things that I would point to just from a macro perspective that's driving that in the P&C segment. And the first is, we've talked around the topic here quite a bit. We're 5 years into a hard market here. And if you're to use the publicly traded P&C carriers as a proxy, we've gone from, call it 9.5% ROEs, up 600 basis points to like 15%, right? And price to book multiples have gone from, 0.5, 0.6 to 1.6, 1.7, right? So that's a long-winded way of saying a lot of the cyclical tailwinds have been priced in to these assets, which I think is creating a little bit of hesitancy as it relates to the balance sheet deals at this point in the cycle. And the second is you just got this, overhang related to adverse development on the casualty side of things, which whether that's real or perceived for a specific asset, it's a challenge that I think most P&C carriers are facing. And then lastly, I guess it's probably less specific to, situations we've discussed here is just challenges in the personal lines side of things, right? The industry in an aggregate is writing north of 100 combines, and there's a lot of issues that are driving that are hard to figure out. Frequency of weather events, there's changes in the reinsurance market that are driving up attachment points. So a lot of challenges in the personal lines, and I think the confluence of all of those things is putting the brakes on the P&C carrier activity, at least in the immediate term. All of that can create opportunity, though. That's the silver lining. But I think that's what's being reflected in the numbers that we're talking about here.
And if I just could come back around and make one more point, building off of what Keith said, we think another thing you see, particularly in privately owned carriers, is creative structuring put in place to get deals done, and not just a straight acquisition of a business, but either a division of business into sort of underwriting franchise value and capital, or breakups, or other forms of transactions that allow sellers to unlock value in a way that they may not have been able to unlock had it just been a straight sale of the business. And I think a great example of that was something we were fortunate to be involved with earlier this year, which was the announced combination of SageSure and Giovera, where Giovera had been owned by FlexPoint for a decade plus, and this really we view as a real win-win-win for SageSure and Giovera and FlexPoint, in that two extraordinarily high quality businesses coming together, but in a structure that allowed FlexPoint to maybe realize value that in a different way than they would have had it just been a vanilla sale process, let's say.
So turning to companies that are not doing well, could M&A become a survival tool for distressed companies? Could it tempt opportunistic buyers to enter the market? And Keith, would you want to take that?
Yeah, for sure. And I think, John and I did not collude before this, but I think that was like the perfect segue, right? Because I think if you consider some of the challenges that I just walked through, and then you look at kind of the macro overlay, which is, the narrative of higher for longer with interest rates, coupled with, insurance rates moderating or potentially even softening over time. I think you're going to see, more dislocations over kind of the, immediate/midterm, which, I believe investors will continue to put capital against those opportunities, but will be highly selective in what they pursue. And I think it requires, to John's point, a lot of creativity in terms of how you structure those deals. So at the risk of this sounding like a commercial, I think, late last year, we invest in a business called the Mutual Group, which was, I think, core to what I just said. And it was all rooted in our belief that the mutual industry was comprised of a lot of small to mid-sized carriers that were fundamentally strong businesses and had a real value proposition, but were at a structural competitive disadvantage to larger carriers, right? So if you could put the right capital support and operational efficiencies that come through scale benefits behind that opportunity set, there was a real kind of way to drive value. So that's kind of one example. The other example that we've seen recently, I would say, is in kind of like the sidecar or sidecar-like market, where over the last 18 months, that was almost like exclusively taking advantage of the generational kind of rate environment on the property cat side of things. And what we've seen recently is people starting to leverage those structures to address some of the issues that I mentioned on the casualty side, and whether that's capital relief, capital optimization, maybe a combination of the two. I think that's kind of a really interesting trend that we've started to see, I should say, take hold here.
Yeah, and I'd love to just jump quickly in on the sidecar point, because it's core to what we do within our business, and we would agree, Keith, that I think we're seeing lots of different pockets and forms of private capital and different types of institutions get more comfortable with taking, either as part of a platform investment or separate from a platform investment through opportunistic strategies, take that underwriting risk more directly, particularly in the hard market that we're in. And it does just raise a broader theme of, as you think about these creative structures, as you think about, the way that private capital is trying to access the space, we're seeing much more comfort, I think, with investments in distributors that are taking some responsible and prudent degree of underwriting risk within their structures, and conversely, I think giving a lot of credit for maybe traditional balance sheet businesses that have built strong sort of fee-oriented either asset management or sort of other capital management businesses to complement their core balance sheets.
Yeah.
The question was about distressed companies, and on the personal line side, I think a lot of those companies have been struggling with like historically high combined ratios, well into the triple digits. And I agree that this has been a hard market if we have to describe it, if we have to pick one. But in many ways, there's a lot of like micro markets, like certain commercial lines are getting price increases and are doing really well, and have low to mid 90s combined ratios across the industry, whereas personal lines or some other lines are having a lot of reserve development, high combined ratios. It's not as good a market on that side. And I figured that some of those niches, particularly personal lines, homeowners, and auto, they're struggling a little bit. I'm surprised that some larger carriers haven't seen that as a opportunity for them.
Would that tie into what Keith is talking about with the mutual group? Just mutual companies, because of their structure, tend to struggle a little bit more to raise capital. And is that a fair assessment?
Yeah, I mean, I think structurally it's more difficult for them to raise capital, but I think back to John's point, I think there are creative ways around that, and that'll be the opportunity, I think, is people that are able to kind of embrace that complexity and structure things that make sense.
Yeah, I agree with the comments about mutuals and the scale needed. Like Keith, I think you were spot on with all that. There's a question that came in recently about, where'd it go on the chat over here? About if mutuals and low deal volume, and if an uptick in mutual holding companies. I do kind of tend to think that we'll see more companies convert to a mutual holding structure. It gives them a lot more flexibility in where their capital comes from, and I think they may need to do that in order to survive.
Thanks, Chris. Kind of following up on the sidecar as a way for capital to enter the market. I was hoping we can come to Phil. I'm sorry. With back to John. Sorry, but how hungry is private capital to enter the market today?
It's a little bit of a better question for Keith even, but look, I think there's there's a lot of private equity capital looking to be put to work. And I think, as I think it was Phil said earlier, certainly less supply of quality deals and quality assets than there is supply of capital to acquire them. So quality assets are still being courted and acquired at strong valuations with enthusiasm by private capital. And I think you're starting to see a little bit of what I was talking earlier, but some private equity investors move a little bit down the risk curve a bit to establish a platform and establish a beachhead, whether that be in the distribution space or whether that be in the MGA space. But a lot of capital looking to be put to work, and a lot of frankly a lot increase in direct investment either alongside or independent of a lot of the sponsors as well from institutions like pension funds and family offices and the like. So interested in Keith's comments, but short answer is quite hungry.
Yeah, I mean, I would completely agree. I mean, I think a lot of, I'd say, these nuances and challenges that we've talked about over the last almost hour or so, I think just create a lot of opportunity, right? I think just given where we are in the cycle, it requires being very thoughtful about where you allocate capital across the insurance value chain. But I think these things actually create more opportunity than we've seen over the last couple of years. So I think there's a lot of appetite for folks that focus on the insurance space to deploy capital against that opportunity set.
Yeah, it really is one of the few industries that consistently has a recurring revenue model. I mean, I think, again, at the distribution space, it's highly attractive. The risk profile is very low relative to the types of return that can be achieved by investors or independent entrepreneurs. So there's not a lot of conversation, or the word distressed doesn't come into play a lot in the distribution space. Certainly at the carrier level it does, but insurance brokerage, I believe, is probably one of the greatest industries to ever exist in the history of the world. As an investor, and so unless that final those kind of fundamentals change, which I don't see happening anytime soon, there's going to continue to be a significant amount of interest from sponsors and private capital to continue to flow into the space.
We're coming up to the end of our hour together, so I'd like to thank the audience and thank our panel. I'd like to go around our virtual table one more time and ask the panelists to share their closing thoughts. What is it that you would like the audience to take away from our discussion today? And if we could start with John and then come to Phil, Keith, and then Chris.
Yeah, so maybe just emphasizing some of the points that were made earlier. I think that context is important as you consider the M&A outlook for the next couple of years, and I think it's our view at Howden that we're more likely to see sustained hard market conditions, just looking at some of the underlying drivers than not. And we think that is going to give rise to a continuation of creative structures being employed in deals, in different structures and different forms of capital accessing the market in different ways. So it's going to continue to be an environment where cookie cutter M&A deals will be tough to get done, but there's absolutely demand and interest from both buyers and sellers to find interesting ways for businesses that are strategic fits to come together, and or from financial investors to sort of buy into the right platforms at the right price and grow them into something more than they are today.
Thanks, John. And to Phil.
Yeah, I think, again, focusing on the brokerage space, it's really easy to get lulled into a sense of comfort. We've been in what's been described as a 5-year-long hard market. There's been, over the last 3 years, more M&A activity than the industry's ever seen. Tax rates are relatively low to where they will probably be at some point in the future, and valuations are higher than they've ever been. So the stars are aligned, and brokers have to make a hard decision to say, is now the time, or are they going to continue to lean in and invest and grow their business? But firms who are treading water and make a decision to remain independent are going to wake up at some point in the future and realize that they're worth less than they were a few years back, and wish they would have had taken action of some sort to either dig in and invest in their business, or partner with the right firm to help them continue to scale. So it'll be an interesting time to continue to watch what happens in the brokerage landscape, both at the retail level and then in the MGA and wholesale level as well.
Thanks, Phil. I'm coming to Keith.
Yes, I mean, I agree with everything John and Phil said. So maybe I'll focus less on the industry specifics and more on the macro. But if you kind of consider the macro complexity that exists, whether it's interest rate driven or otherwise, and also kind of overlay some of the geopolitical concerns, our view would be the insurance, industry is a great place to allocate capital in times of uncertainty. But as John mentioned, I think it will continue to be driven by unique approaches, creative structures, all the things that you would expect that folks like us would need to deploy, as things become harder, right? As you come out of a hard rate environment. So I think there'll be, it'll be more challenging, but I think there's more opportunities that exist.
Thanks, Keith. And Chris.
Yeah, maybe I just don't want to admit that I'm wrong, but I like to think that we'll finally see some insurtechs and distressed companies become targets. Unless regulation changes, I think we'll continue to see private money flow into insurance companies. It's too good of an industry for it not to. And well said on everybody's comments about brokers and MGAs. Meg, at your conference last week, that came up several times. People were expecting consolidation. Patrick Gallagher from Arthur J. Gallagher said in an investor call not too long ago that the broker space is fragmented, small, and that adding them being the brokers to their platform was going to create a lot of value to clients. So that trend's definitely going to continue.
Great. Well, I'd like to thank our panel, Chris, Keith, John, and Phil, for taking the time to share your insights, and thank the audience for tuning in. We'll have a replay available in just a few moments. For Insurance Insider, I'm Meg Green.